Hey yeah guys, it's Davey Mack here and Sean, the friendly neighborhood tax men now, men, this time, because there's two of us. Cool, all right, so Sean, maybe you should introduce yourself.
So I've been here at Box Advisory for about 6 months now, and previously I used to work at Financial Advisory. But yeah, really excited to be working in accounting and meeting small business every day. And here today we have a couple of frequently asked questions for small businesses.
Yeah, basically we're going to be answering a frequently asked questions about anything to do with taxes. It's pretty much what our clients talk about. They ask us a lot of questions. Sean's been managing the phone calls, the sales, and we've pretty much been getting a whole list of common questions asked.
Absolutely.
Yeah, so we just want to go through all of it for our clients and people like yourself, so you can stop asking us so many questions. So let's start with the first question that we normally get asked. What structure is best for my business, Sean?
Yeah, so the first thing I'll ask is, what are your goals and objectives? Some people, they would want to purchase a house, they'll want to get a loan for a house. Some people want to build wealth for their family. Some people want to build the next biggest thing. You know, they want to become the next Apple. Some people want to start up their new e-commerce store. So it really depends on what your goals and objectives are.
Yeah, so once we know what your goals and objectives are, we also want to know about your personal situation and your family situation. So we asked about, what is your income currently in the business or that you think you're going to be making in the next 12 months? What is your family's income? How much is your wife or partner's making? How much is your kids making? Are your kids over 18? Do you want to pass any profits over to your family members? Can your family members work in the business? And then we also ask, what's your assets and liabilities personally? Because then we want to see if something happens to the business, would it impact your personal assets as well? So we'll ask a whole series of questions, and then we gauge, okay, what type of structure is best for your situation, not just for tax minimization, but also because of protecting your assets, because you can set up a separate structure. Then your separate structure means that the business are separated. So therefore, if you get sued because you're running a business and it's the business that gets sued, they can't go after your personal assets as well. And you might have a house and for your family. That's the reason why we always ask those series of questions. But if you're just one person and you don't have any personal assets, then we might consider maybe we should go for the most simple structure, which is a sole trader. And then we can talk about cost as well, right?
Yeah,
cost
absolutely.
is a big problem too. So it just depends.
Yeah. Speaking of asset protection, just to make things a little bit fun, I always like to tell clients, think of protecting your assets in a company like Iron Man versus Thanos. Where your company is Iron Man's suit of armor, and then Thanos in the fight smashes on Iron Man's suit of armor. And without Iron Man's suit of armor, Iron Man would probably break a limb or something like that, right? Yeah. But with that suit of armor, it provides good level of protection, but it's not invulnerable, it's not impenetrable. So, for example, if you had that, or you have a ton of risk, it depends on whether or not you are fulfilling your director's roles and responsibilities, and you're also not doing anything fraudulent. Yeah. If you are doing anything fraudulent and not fulfilling the director's roles and responsibilities, something called a corporate veil can be lifted, where Iron Man's shield, basically your company, would not be able to be protecting yourself.
Yeah, so they can go after the director. So basically the whole the Iron Man suit is basically the company or a family trust or some sort of other entity that protects you. So we don't go trading under your own personal name, which is kind of like a sole trader, where if something were to happen to the business that you're doing, you don't actually have an Iron Man suit to protect you. Yeah. And so therefore they can just basically go after you personally, and you can get damaged, and that damage could be permanent on your record. Yes. So they could pretty much take your assets. So it's quite scary. There's also another thing that you could get done for, which is insolvent trading, which means that if you're operating a business for a company and the business cannot afford to pay its debts and shouldn't be trading at all, that's also called insolvent trading, and you can't really do that as a director as well. So they can go after you personally because you're trading insolvent. Yeah, man. So we do ask a whole series of questions. It's very hard to answer the question without diving deep into the client's situation. So it really depends, but what are the key things we look out for?
So once again, we look out for tax planning, we look out for asset protection, and we look out for succession planning.
Yep.
So what's your exit strategy? What do you want to do in the future?
Yeah. So let's dive deep on those three characteristics. So for tax planning, put an example there, you're making about $120,000.
So 120K is a golden number that we use because any dollar that you earn, personally over $120,000, is going to be taxed at 37%. So a company has a flat tax rate of 25%. So if you earn anything more than 120,000, it would start making sense to pay for the accounting fees for starting up a company to get the tax advantages, and therefore your overall tax expense would reduce.
Yeah, so it's pretty easy these days to turn over 120K. So is that like turnover or is that profit?
That's profit.
Yeah, so it's basically the profit of a business. So these days, it's not that hard to get over 120K, like $10,000 a month. That's all you need to make profit, and then you're over it. So we usually tell our clients, companies, and that's why probably a lot of businesses create companies, but why create a company rather than a trust?
Well, it depends on, once again, your personal situation. But you usually would create a trust when you have beneficiaries to distribute the funds to. So think of a trust as if it is a pipe. So water flows into the pipe and the water will go to the different outlets. If the water gets stuck in the middle, the pipe would burst, and the bursting of the pipe is a 45% tax rate. So the water is your profits and the outlets are your beneficiaries. The bursting of the pipe is a 45% tax rate.
Far out, that's a really good.
Yeah.
That's a really good symbolism. Like for me, I never heard of that one. That's actually really good. So basically, yeah, a trust acts very different from a company. A trust has to pass the profits over to its beneficiaries. If it doesn't, it bursts and you get taxed at 45%. It's a penalty tax and it's really, really high. So it's only useful when your family can have the profits over 18, because the family members have to be over 18, they can't be minors. Back in the day, it used to be very good because minors could get a distribution of profits and pay very little tax. But now you have to be over 18 and you have to pretty much be on a low tax rate. So you have to look at your situation with your family and see, is your family making any income? If they are making any income, is the family trust really the perfect structure for your business? Maybe, setting up a company is better, but there are cons of setting up a company. The cons are basically that you don't have that flexibility on passing the profits over like your trust. It's basically whoever owns the shares of the company. If you own 100% of the shares, that means that the profits only go to you. And that's a very big downfall. And another downfall is basically that you own the shares of the company. Yes, there is asset protection, meaning that and we'll go into detail of that, but the company can get sued, and if the company gets sued, they go after the company for the business dealings that they had. However, the person, the shareholder, can get protected because they're going after the company and it's two separate legal entities. But the downfall about that is it doesn't happen the opposite way, whereas if the individual got sued, because they were at the bar, got into a fight, that person injured another individual and that individual decides to sue him, they can go after that person's individual assets. And if your shares are owned under your personal name, that basically means that they can go after your personal assets, which is the shares of the company. Yeah, but firstly, I'm not a legal advisor and Sean isn't too, we're just accountants. So we just heard from someone and then someone told us this, so don't trust what we're saying in terms of the legal advice, because that is not legal advice. It's just for entertainment purposes, basically. So that's tax planning, right? So what about asset protection? Let's jump into that. I did mention that a few times.
So in terms of asset protection, one thing very special to a trust is that the trust is actually on its own, as in like it's controlled by either an individual trustee or it's controlled by a corporate trustee, but it's not owned by the individual trustee or the corporate trustee.
Yeah, and the trustee is basically the controller. They control the assets. The way the trust separates different parties, and instead of you owning the asset and you running the asset under your name and you controlling it, the trust separates that. They say the controller is the trustee, and then the ones that actually benefit from more the profits is the individual or a bucket company or anything like that. Yeah, so that's where asset protection comes in. We're separating different responsibilities different parties from the assets or the businesses. And by doing that, you can basically protect your assets, because if we pull away some of the assets and put it under a trust, or we pull some of the assets and put it under the individual and have the company have assets for the business and run a business for it, then you're separating the legal responsibilities. So as a result, company can get sued for the business, but they can't go after the individual because the individual has nothing to do with the company when it comes to business.
Yeah. So just, to summarize, having a trust is really good to separate the legal entities and separate the ownership.
Yeah, and the problem with the company is that the company is great for asset protection. You can separate the legal entities, but the only problem is that the company's shares are owned by the individual. So yeah, it can protect the individual from the company, but the opposite way around, where the individual gets sued, the assets of the company get tied into that issue.
Yeah.
Okay, not legal advice. So, and last thing was succession planning. So how does succession planning affect the business structure?
Yeah, so I think in regards to succession planning, Davey and I, we usually like to recommend having a hybrid of the two.
Yeah.
Where you have a company, but the company is owned by a trust. And the big reason for that is because when you sell the company, you would incur capital gains tax.
Yeah, sell anything. Like if you sell a business, or when you want to pass the business, and usually when you grow a business, you make quite a fair bit of money on it, and you get to a point where, okay, I want to move on. A lot of business owners do that, and when they want to move on, they either want to sell it to someone else, or they want to sell it to the family members, or they want to pass it over to family members. Especially if you're running the business through a sole trader in your personal name and you want to pass it off, it incurs a capital gain straight away, because you had to dissolve your business as a sole trader and give it to someone else. That means that that person takes over the business, so there's this capital gain, even if you gave it for $1. That's the problem. So that's why they call this succession planning. So how do we pass the assets or the business over to the next person in line without incurring too much issues? And issues could be tax, could be stamp duty, it could be just a whole bunch of admin costs and time. So by doing that, we think about, like, family trust is probably the most perfect thing, right?
Yeah, absolutely.
Yeah, because the family trust, like we were saying before, they separate the ownership. The ownership is actually passed to the beneficiaries, and you can include the whole family as a beneficiary. So that means that succession planning is taken care of, because your family is going to be can take the profit now. Yeah.
And in terms of control of the company, think of it like that. Why would a trust not incur CGT when changing ownership, whereas a company owned by an individual will incur CGT? The main reason is because when an individual passes the company shares to another individual, whether it's their kids or whether it's his brother or whoever, that would be a change of ownership. Whereas the trust is controlled by something called a trust deed.
Yeah.
And the trust deed would tell who controls the company which the trust owns, and you can just simply change the controller of the company through the trust deed.
Yeah, well, the trustee passes the profit over. They decide at the end of every year, okay, this is the profit of the business, and we're gonna pass this profit over to this beneficiary number one, which could be the mum and dad. And then next year they can go, all right, well, the mum and dad's not really running in the business anymore. They've retired, they're chilling in Thailand. They say, oh, look, you can take over the business. The trustee can just determine to distribute the profits to them. So there's no need to change capital gains. There's no need to move the shares over to the new owners. It's owned by the family trust, and the trustee decides, okay, well, because you guys aren't running the business anymore, we're gonna give the profits to the kids. That's it. We don't have to do anything. So that's a great thing about succession planning. And those are the questions we have to ask. We ask them about, their personal situation, their income, the assets they have personally, what are we trying to protect? It's funny when clients come to us and they want this complex structure. They want a trust involved, they want a company involved. And that's what you were talking about in hybrid version, where we can get a company, which is a trading entity, and a trust at the top of the structure. So by having something like that, the family trust owns the shares of the trading company, and the trading company is the one that trades. So you get best of both worlds, where the company gets taxed at 25%, the business, and then when you want to pass profits over, you pass it to the family trust, and then, like you said, with the analogy with the pubs, will just redirect the profits to whoever in the family that deserves the money, right? And then if the family members in the family have a low income, then we enjoy a low tax rate, right?
Yeah. Speaking of low income and low tax rate, there is something that you really will want to look at when starting a trust and distributing funds to members of your family that has a low income is Centrelink payments. So your age pension, especially this is especially true for retired parents. If you want to distribute the profits of your company to your retired parents, they may be on Centrelink age pension. And there is something called an asset test and an income test. The income distributed from the trust to your parents may increase their income and therefore they would not pass the income test.
And they'll lose their age pension. So it's sometimes family trusts are like, a lot of people hear about it, and it's kind of like a car sales type of, a lot of people sell family trusts, a lot of accountants sell family trusts and say, set up a family trust, you can minimize your tax, you can protect your assets, and then they go and set it up. They spend like a couple grand setting up a family trust. Then they realize they can't even use it, because if they distribute the profits to their mum and dad, and they own an age pension, they'll lose their age pension. So you decide, okay, well, I can't distribute it anymore, I need to my mum and dad. And then they go, well, maybe I can distribute to my kids. So the kids are under 18. So if you would distribute the money to the kids, what do they get taxed at? 45%.
45%.
Yeah, so that's not a good move as well. So they end up distributing the profits to themselves. So what's the whole point of a family trust? Yes, there is asset protection, 100%, but does it always minimize the tax? Not always.
Yeah.
It does incur extra costs.
Yeah. So you will ask me, Sean, so when would I set up a trust? When would a trust benefit me in terms of tax planning? Usually a trust would really prove to be beneficial for tax planning if a family is already quite wealthy. Because if a family is wealthy, if the parents are wealthy, they do not get the age pension because they do not pass the assets test.
Yes.
So when the income from the business gets distributed to the parents, they do not lose any Centrelink payments because they didn't receive any Centrelink payments in the first place, but the business does get the tax benefits of distributing income.
And if your family is huge, I'm talking about massive, if you got like 10 plus people in your family, you can probably distribute the profits throughout the family, which is great. Then there's something about bucket companies, which we have a video about. You can just watch the video. All right, so the next question then is, can I claim startup costs?
Absolutely. You could claim any startup cost as long as it's for running your business.
Yeah, so if you're not running a business, you can't claim the startup costs. So what are cases where you're not running a business?
It would be for an investment property.
Yeah, so for example, if you've got an entity, which is a company or a trust that owns investment properties, you're not technically running a business. So therefore, you can't claim the startup costs. But this is the weirdest thing. If you do ever sell the company or the family trust that owns the investment property, then you get to claim it as a cost base when you do the CGT calculation. But leave that to the accountant. It gets a bit confusing then. But pretty much rule of thumb, if it's a business, you can claim the startup cost. And do you get to claim it all the way up front?
Yes, you do.
Yeah, so there used to be something called black hole expenses where you can claim it over 5 years. But recently the new rules have changed and they basically said, if you're a small business, you can pretty much claim startup costs up front. So what are startup costs? Like, a lot of people forget about what is actually startup costs.
Yep. The first one you'll probably get is your accounting fees and your asset payments to start up a whatever structure you want to start up.
Yeah, so if you set up the company, you pay about $600 usually, or you might pay a bit extra, $1,000 if you get the tax file numbers and ABN registrations, all that stuff like that. You might have some extra costs for legal costs as well and advisors to set up the structure properly. They're the most common ones, I think.
And of course you got your bank fees.
Yeah, and then like maybe website domain fees as well. That might be ones as well. Basically anything you spend yourself in your own personal name, you can claim it as well. You treat it as a director's loan, like as in the company, you've lent money to the company, you can still claim it.
Now, one question a lot of people ask about claiming startup costs is that, hey, I paid my accountant before I even started up my company. My company did not exist.
Yes.
I paid my accountant
in their
first.
personal bank account.
So is that claimable?
Yeah, of course there is. Yeah, so then they say, how do I claim it? Basically, you get an accounting software and then you obviously get your business bank account set up. And then once you get the business bank account, you can either reimburse yourself or you can put it in as a expense for the company as a bill in your Xero accounting software, and then code the other side of the journal to, obviously not to the bank account because it never came out of the bank account, code it to director's loan, meaning that the director has lent the money back to the company so you can claim it. Am I right?
Yeah,
I think
absolutely.
so. Yeah, cool. Cool, all right. Whoa, what was the next question, Mr. Sean?
How do I do my bookkeeping? Should I use an accounting software?
Do we need accounting software?
So could you fly a plane with a blindfold on?
You need accounting software. Like accounting software doesn't have to be something complicated. It doesn't have to be a Xero, it doesn't have to be MYB. We would recommend you use Xero and an accounting software, a cloud-based one. And the reason being is because having an accounting software that is built specifically to track your income and your expenses and your taxes and your wages makes life easier. And the longer it takes to not have something set up, the more confusing it gets and the more likelihood that you have bad habits where you just don't track that information. And then at the end of the year, everything's a mess. And we've seen so many clients that come to us, you know, after 12 months or 24 months of trading, and they just go, I don't know what to do, Davey. And then what happens then? The accounting fees are more expensive, the tax bill is massive because they haven't been paying any taxes whatsoever. But like I said, accounting software doesn't have to be too complicated. You can use an Excel spreadsheet as well, right? Excel spreadsheet is pretty much another form of accounting software. It helps you track your income and expenses. Yeah, do you want to add anything?
Yeah, and I would say that the reason why a lot of business owners do not have a good accounting software and good bookkeeping done is because really it's a reactive thing to do. In terms of human nature, like me myself, until I really have to get my shit done, then I go and do my shit.
Yeah.
Like, you know, it's not in human nature to proactively do something that is not necessary. So as long as you don't think of bookkeeping as a necessity, generally people wouldn't go and do it. But really, bookkeeping tells so much about your business. It tells you exactly from a month-to-month basis, what are your biggest costs, what are your biggest money makers and stuff like that. And if you can segregate those accounts to tell the story of your business, you'll be able to run your business at a much more profitable level.
Yeah, and you probably will be successful if you actually track your numbers. The whole point is that I find that, because I've been doing this for a very long time, like about 14 years in accounting, I find that a lot of reasons why business owners don't actually have a bookkeeping software or do their bookkeeping is because they don't know how to. That's the biggest problem. They don't actually know how to. They've never been taught how to do bookkeeping. They don't even know what bookkeeping is. They don't even know what accounting software does. So that's why we do what we do. We try to educate our clients, we try to train them up, and we actually do our software training for free. We actually train them up as long as you've got a package with us and you're working with us as a paid client. We actually do the training and we spend like hours at the start to kind of make sure you know what you're doing with your numbers. And that the whole reason why you need to be taught that is because we learn that stuff in uni. Like in uni and CA course, clients don't expect to know this stuff. Yeah, so they don't know about the taxes they need to pay. They don't know about how to record their income, what they need to record with the ATO. So they need to be taught. The ATO does a good job, but in the end, it's better if we sit down and train the client and explain that to them. So if you don't have training or you don't understand bookkeeping, get it. Like, get the training properly, pay for it. Don't be a tight ass, actually pay for the accounting training. And once you get that, you'll realize that you're running an okay business, a successful one, or you're not running a good business and you should stop. Tell me about it. Like, have you seen clients that run their business for multiple years, and once you've done all the books and done their tax return, you sometimes ask yourself, why is this person in the business in the first place?
Yeah, definitely. Sometimes when your bookkeeping is not done, the most basic questions could not even be answered. One of the most basic questions in business is how much profits are you making per month or per year?
Yeah.
If you couldn't answer that question, then you really should go and seek out the answer.
Yeah, no, I was gonna say, like, they try to answer that question thinking that the bank account is their profit. So you know what I mean? Like, that's the problem. The guys that don't do their bookkeeping, they actually think that their profit is whatever's in their bank account. Do you think that's not true, right? What's in their bank account? Like, what do they have to pay as well?
Yep, so you have your salaries, your PAYG, your tax obligations, your GST, that's just to name a few.
Yeah, and then there's your superannuation, and then you got your bills, you got your client, the bills that you haven't paid, you might even not know that you're aware of. So all that money is sitting in your bank account may not be yours because you still have bills, liabilities, taxes to pay. And then once you don't do your taxes, or don't get those invoices and bills, or don't pay your superannuation for your employees. And then you decide, okay, let's get it all done because you have to. And why do you have to? Because sometimes you're going for loans, or sometimes you're trying to rent a house or a home. You need to provide those documents. And when you try to provide those documents to try to buy a house, or to borrow money, or to try to rent a house, you then have to pay for those taxes. Then you have to lodge a tax return. Then you have to show your book. That's where you realize, holy crap, I don't even have any money once I pay for all those expenses. And that money in my bank account wasn't necessarily mine. So that's where we sit there with our clients and we go, you should close your business down, or you should do something, or you need more money, or something's not working. And we could have told that person earlier, but the problem was we can't tell them because they didn't do their books in the first place.
Yeah, absolutely. And if you feel like you're in this situation, don't worry too much. You should start actioning it. But there are a lot of resources available online. And that's also one of the big reasons why we recommend Xero, because Xero has, out of all the accounting software, the best support system in terms of educating clients.
Yeah, and Xero should really pay us for this video.
We are not sponsored by Xero in any way, but yeah, Xero, hit us up.
Hit us up, please, mate. I've been trying to, mate. I do a sneaky where I hashtag them sometimes just to see if they, respond, but they don't bloody respond, man.
Yeah,
I'm
you
a
get
very
paid for
good.
this.
I know, I'm a good accountant, mate. I can refer you a lot of work. So, guys, if you're hearing me, Xero, please contact me. I don't charge that much. Okay, so these questions are going way longer than expected because we're just getting too excited here. Me and Sean are having a party. So we gotta cut it short because you guys got better things to do. But stay tuned for part 2. Then we're gonna talk about more frequently asked questions.
See ya.
See ya.